See here, kid. You gotta just go for it. Don't think about what comes after or what came before.
When I first started investing, it was during a nationwide pandemic. And with that came a lot of free time to sink into, and yep, that's my ugly mug right there. I had a small amount of money that I wanted to grow and eventually live off of, and with time I was able to start making a future for myself within my investing. Don't get me wrong, as an investor I'm still learning, and every investor in the world is still learning. So take solace in the fact that if you're wanting to learn, you're not alone. Maybe you've heard on the news about what could happen if you invest in something that could grow. Maybe you just watched Forrest Gump again and his rise to wealth with Apple. Or maybe you simply saw TikTok about some ridiculous gain that made someone thousands and thousands of pounds or dollars, and it's piqued your interest. Either way, you want to learn how to invest. But you don't know anything about investing. You did some simple digging, saw stock chart with huge lines, a lot of numbers, and that sounds like pigline. What is a stock? Where's my money going? Can I lose more than I invest? Can I make unlimited gains? What is a good investment? I want to tackle all of these questions in simple, easy to understand terms that you as a new investor can understand, because when I first started, there was so much that I just didn't understand and I couldn't get a simple answer to. So I just want to help in any way I can. I don't like to flaunt my portfolio, and I don't like to flaunt how much capital I've gained. I'm a humble person, but the reason this guide can be so helpful to new investors is because not a long time ago, I was in your footsteps. I had £500, a lot of free time, and as of today, I've grown that capital into just over £15,000. And everything I mentioned in this video will give you the tips and tricks to do the same with an even better understanding than when I first started, because I understood nothing. Simply put, if you have money sat in a bank account, your money will just stagnate and depreciate due to inflation. Inflation is where the price of produce and items within an economy increase in price, but your amount of money stays the same. This in turn makes your money worth less comparatively. For example, in 1990, a pint of milk was about 25 pence. Then, flash forward to 2018, the price was 44p, but the money you're using hasn't changed any, but it's lost value. This is where investing is such an incredible asset to learn, because you can invest in several ways depending on your income streams, and curve the inflation, because with investing, as you invest, the money will rise with the economy and with inflation, and most of the time beat it.
What if you don't? What if you fly?
In layman terms, the stock market is a marketplace to buy a fractional part of a company to gain capital from the performance of the said company. When you invest in the stock market, you are investing by buying a minute fraction of that company, which is called a share. Investing in shares can be done via many different brokerages, this being the company that you hold your shares with, be it Trading 212, Webull, Interactive Brokers. The list is endless, and all brokerages will have different upsides and downsides, but will save the same purpose in the long run. And the way you gain value by investing into companies is with the foresight and research that the company that you are investing into will financially and competitively succeed in its sector. I think it's important that we discount some of the forms of investing and trading from the field for newer investors, because when you're learning how to swim, you don't want to jump into freshwater rapids. I'll explain each theory and then throw the ones I would prefer newcomers not to explore until they're well versed in the stock market. We have growth investors, blue chip investors, dividend investors, day and swing traders, cyclical investors, and defensive investors. You can throw cyclical investing and the traders for now, as we mentioned above, and this gives us some core investing methods. Growth investing is investing into companies that have expected growth potential in the coming years. Think of it as the crest of the stock industry. They'll grow fast and have high yields if the company is researched well enough, but it's a little bit flimsy. Blue chip investing is investing into companies that are pre-established. Huge market leaders, think Apple, Amazon, Facebook and such. Sure, growth isn't all that fast, but they usually beat inflation and rarely ever fall a worrying amount. Dividend investing is investing into a company that pays you part of the profits that the total company makes, and usually does so by offering the investors a percentage based on their amount of shares. Think of this as an apple tree. You get a constant return from it, but usually they don't grow all that fast. And finally, defensive investors. This investing strategy is investing into highly resilient companies or industries that will stand the test of time. Think of this investing as investing into a dandelion. You'll simply just never get rid of them. The reason I've labelled each type of investing with a plant is because the idea is for the investments to grow. Sure, some plants grow faster than others, but these can be affected so much more by things happening in the market. Whereas the perks of a tree is that once it starts growing, it'll rarely get taken down. I'll try to make this concise. Investing in companies takes time and research, and if you have this, you're set to jump into researching stocks, finding like-minded people, shameful plug about free Discord, and finding a stock that you can see as having properties of growth. There are multiple ways of finding stocks and multiple websites dedicated to giving you some info on stocks that could do really well in the future, and that could match what type of investor you would like to be. But what if you don't have a lot of time, but interested in a certain sector or market? Well, then we'd look at index funds and ETFs. These are a singular fund that is made of fractional shares of a collection of companies that fit the ideal of the index fund or ETF. There are a multitude of different types of ETF and index funds, and they are both managed as a whole for you. ETFs have varying levels of success because usually they're based around a type of sector or market, but if chosen correctly, are very safe for newer investors to invest in and leave. Index funds are popular investment funds run by incredible investors or conglomerates of investors with great returns rates. Funds like Vanguard, BlackRock, for example, handpick companies that they think will be successful. These are incredible for people just wanting to invest without the time crunch of sitting down and researching individual companies. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." And this speaks levels to why people believe the stock market has a massive risk involved. Earlier, we took trading and cyclical investing away from our horizon, and it left us with types of investing for both proactive and dormant investors. And these are intensely safe. But at the same time, there is always a risk involved, no matter how tiny. As new investors, we tend to make our first investment and then keep an eye on it every day waiting for it to rise, and when this happens, it's amazing. But when the opposite happens and the stock falls a few percent, we worry. But this is natural. Stocks go up and down all the time, and a percent or two here and there is nothing to worry about. Hell, it could stay down 2% for a month. If that stock's going to rise, just wait it out. If the reason you initially invested is the same, you have no need to worry. I know too many people who have invested in a company for the first time, watch the stock fall a little bit, get worried, take their money out at a loss, and curse the stock market for being a cruel mistress. But the following week the price goes up and they curse both the stock market and themselves. As a new investor, you're going to feel connected to the up and down days, but my biggest bit of advice I could give you is to detach your emotion from your investments. Simply let the stock market do its thing, have a buy thesis, stick to it, and if that buy thesis doesn't change, don't touch the stock. Sometimes there are simply red days, it's a natural part of the cycle and there's no need to worry. This one's simple. If you have no debt, have some money laying around that you can start your journey with, or just received a small amount from a birthday or Christmas, try it out. Start small. You can always build up in the future and give it some time, thought, and research. Find like-minded people to help and assist you, shameless second plug, and start your journey into the market. You can start with a paper account if you like, which is just playing with imaginary funds. Anything like that helps. As long as you're putting your toe in, you are learning. Easy. Pick your broker, sort out all the necessary information required to join, and then either start your paper account or deposit your starting amount of money, which should be an amount that you're willing to play with and willing to lose. This shouldn't happen if you've taken the first steps of the video into account. Then research. Use the websites we've spoken about, follow some guides for beginners, and read company reports. Most importantly, just get involved with the community. Last plug, I promise. But we've been working on a free Discord that teaches people the value of investing. We publish free guides and reports weekly, and our reports are currently both up over 100% in a week because we only pick growth stocks with great long-term potential. We teach why we've chosen those stocks, what's appealing about them, what markets they belong to, and go into the nitty-gritty detail, which is really solid stuff for new investors to learn about, so I definitely recommend it. I may be a bit biased. Finally, I'm just asking for criticism. This is my first video and I'd appreciate it. I'm wanting to educate as many people as possible on the value of investing, and I have a whole host of potential ideas lined up, and I thought this was a great place to start because I'm so connected to it. But for now, this is DD-Bae signing off.